But how much have I put into this development itself, the actual development? Not a cent.
You've put down $4,000, and with your brains, you've been able to create over the last 2 years more money than most people make in their lifetime.
It is a high risk environment, like just put it very plain. It is. You know, I might make it sound easy, but I invested in myself.
And we are live. Welcome to Aus Property Investors, where we have the big names and we have the big fun. What's going on? We have Adrian Cicchino here with Steve Palise as co-host. How are you, Adrian? Nice to have you here.
I am well, Joe. I'm well. Yeah, thanks for asking me to come along and be involved.
Mate, it's fantastic. I love getting property investors on, people that are sitting in the background, making stuff happen. You were very reluctant to come on this podcast. You've got nothing to sell us. You came kicking and screaming, but you somehow have managed to do some no money down deals. And making money is a big part of property investing, so I wanted to do that. But we're lucky to have Steve Palise as well. How are you, mate? Over in the UK at the minute, so it's a bit sunny there.
In the UK, yeah. I'm off to Adrian and mine's homeland next week. I'm in Sicily for a couple of weeks, and then just laughing at Steve. How did you pronounce his last name before, Joe?
Well, as it's spelled, Cicchino.
I've heard it many different ways, so I just nod and say, "Yeah."
So, mate, I'm excited. I'm excited for this one. So what's the title of this session? It is How to Create No Money Down Development Deals. So let's jump in. Let's jump into it. So I want to introduce you first. I asked you to send me a bio, and you said, "What's a bio?" So Adrian is an absolute legend. He has over 10 years experience as a chartered civil engineer. If I'm not mistaken, doing projects worth $2 billion. So very heavy in the civil engineering space. And throughout that time, you were building a property portfolio and working on a property portfolio. But one of the biggest challenges that you come across when you're a property investor is we hit this thing called a serviceability wall. And then it's at that point that a lot of people say, you know what, I'm just going to, I hit a serviceability wall. I'm not going to do property investing anymore. But the thing that you said was like, how do I now overcome this hurdle? How do I break through the walls? And how can I create more value and more equity and more growth? And Adrian, you are now a commercial buyer's agent with Steve Palise. So Steve's lucky enough to have you on board helping the amazing clients find amazing deals. Is that what you do, Steve? Is that what he does?
Hopefully, he works from home a lot, so who knows? Adrian's an absolute gun. He looks after most of our commercial acquisition deals and does cracking deals. Even one today, we were looking at 7.35% net yield one in Perth, which is a crack of a deal. So he's really good at what he does. You know what's funny? So I used to see, all the advertisements for no money down developers and all that type of stuff. I have to put a hand on heart. I used to actually badmouth those guys in the industry, being like, yeah, they're sharks. They're doing something corrupt. Until I met like Adrian and Liam and a few other developers actually doing no money down deals, I'm like, okay, there's actually some premise to this.
It doesn't sound great. It sounds very spruikerish. The only thing is, it's not no work down. Like, I think that's one thing you're going to find out is you're paid to the proportion of the problems that you solve. And you're creating some pretty interesting solutions, and you're getting rewarded for that. But there's still not work to do, if that makes sense.
There is plenty of work, mate. Plenty of work. A lot of sweat equity.
So, okay, cool. Well, give us a bit of a run through. We always like to take it back to like, how did you get into property investing? Like, what was it that kind of kicked things off for you?
Well, as a teenager, I always thought I was going to finish school and do architecture in uni. I kind of just liked the look of cool buildings and think, I'd love to kind of let my imagination loose and design these really cool buildings that I was seeing around the place. And then as I kind of got closer to uni, I kind of liked the idea of getting into construction and structures and that type of more bridges and roads type of aspect. So I decided to go into engineering, and I thought, well, while I'm doing that, I'm starting to earn some decent money. What am I going to do with the income that I have. I'm not the type of person that understands shares and ETFs and crypto and all that sort of things. I have no idea at all. But I understood property. So it was, for me, it was an easy venture. If I'm earning some money, where am I going to put it? I don't want to just, sit stale over the years. I want to create income. That's just the avenue that I decided to go down.
Nice. Was there like a family member or a book that kind of like kicked it off for you?
There's actually nothing. My family as well, they're not really into property investment at all, anything like that. I was kind of the first one in the family to kind of take that avenue and invest my money that way. I can't put it down to a point other than I just liked cool looking buildings, and I wanted to create income, and that the two went together, and property investment off it went.
Nice.
I was going to say, in engineering, typically, because most engineers are pretty risk adverse around work, I found Adrian, like, people normally like bought one investment property, even if it was normally based where they were, just because it is, on paper, the lowest risk asset you can kind of get. And there's always chats at work and things like that, which get you into it a little bit.
Definitely. People, it's in the industry where people are earning decent money and they're always talking about what they've got to do with it, So it just comes up and you talk about it.
It's interesting as well, like the way that you thought about it, like no minimal, what's the lowest risk thing that you can kind of get into? I was having that conversation with actually a paramedic today, and we were talking about a deal that he was looking at, and he's like, to be honest, this deal is perfect for what we're kind of looking for, because when I assess things, I assess it based on the downside. As much as I would love to say that this person's going to, absolutely crush it, is trying to reduce as much risk as possible. So here's all the risk and here's all the reward, and am I comfortable enough with the risk? And is the upside kind of outweighing any of the risks that I'm taking? And then he's like, yeah, that makes sense. So it is more of a, how do I de-risk this investment as much as possible?
Yeah, and it comes second nature as an engineer. You're problem solving all the time, and a lot of the assessment I used to do was kind of like likelihood and consequence. If you look at every opportunity as what's the worst thing that can happen, you're never going to buy anything. You're never going to really push your limits and extend. So I was kind of the opposite end of that. I'm kind of like to take a little bit more risk, understanding what the worst case is and what the likelihood of that is, and if the likelihood of the worst thing happens, can I deal with it? Yes or no?
Yeah, you know what's funny? Every single engineer I've ever worked with, they're normally, and you're actually a prime example, they're normally like the worst client because they assess every bit of risk for their first property, and then once they have a good outcome, they go the opposite, because they're now, like you mentioned, Joe, it's the opportunity cost. They're like, I'm silly not to do something like this, because otherwise I'm just working an engineering job for the next 20 years. Like Adrian said, it's the annoying thing with engineering, it's good money, but it's never going to be great money. You're kind of capped at like the managerial level of, like, I'm making up numbers here, it's probably like 200, 250. If you go really high up, like 300, but that's kind of it. So it's like, how do I keep doing this? And yeah, every engineer I've ever worked with, after the first one, they're an addict. They just want to buy. And then you go down to Adrian's route of like, okay, how do I make this even faster and do no money down deals?
Ridiculous. Yeah. It's the right way. It's the right way to think about it, I guess. Like, because the cost of doing nothing is absolutely so much more. Okay, cool. So your first kind of investment property, was that like this architecturally beautiful investment property that was a big mistake, and in hindsight you're like, oh shit, I probably shouldn't have bought that type of property, or was it just your standard, set and forget type of deal? What did the first one look like?
In hindsight, wasn't the best purchase, but it's actually
how good
done
did it
okay.
Look? How good did it look?
It looked pretty average because the budget didn't allow for it to look fantastic. So it was just run-of-the-mill Torrens title townhouse that my wife and I purchased, that we lived in for a little bit, and converted it to an investment when we kind of moved out and started reinvesting.
Love it.
So nothing special.
Yeah. Is that, so you built your portfolio with residential, and then like Joe said, was it the servicing that was the really like kind of push in the back to be like, hey, you got to do something else here? And I know the answer to this because we obviously work together, and I know you've went down the rabbit hole of assessing commercial versus development versus accumulating residential versus buying the principal place of residence. But was it the glass ceiling in terms of like your servicing that kind of said, okay, I need to do something different here?
Yeah, look, I started down the track of, the old school. I'm just going to keep buying residential, hold it for 10, 15, 20 years, and eventually sell it down and kind of live off the passive income. But as I kind of bought another resi and another resi, I was kind of like, well, okay, what's the other avenue? So I started looking at commercial, which would have, is a viable option for many. But again, it's kind of like, well, that only takes you so far. You still got 15, 20 year horizons. How do you bring that in? And you start looking at, a lot of value add options. They come with a hell of a lot of risk. And in a lot of instances, you're taking gambles that, in 12 years time when you're really looking at leases, or you can create some type of value add on the property itself, that you're going to actually get that uplift. But then again, what do you do with it? Do you have serviceability? Can you go again? So I kind of started looking at avenues of, well, how can I speed up the income coming in and kind of bring that, 20, 25, 30 year horizon back down to a kind of, 10, 15 years, even better, even shorter if possible.
Yeah. I think residential still gave you a really good base, because once you've got some runs on the board, you're like, okay, there's been no way you'd ever be able to go straight into development or straight into commercial without having some form of knowledge. And that's how we actually crossed paths. You actually bought a residential in Adelaide through us, and then that's done really well, which I think you're still planning to sell it at the moment. You're actually going to sell with a couple $100,000 uplift to then put into development to speed things along even more so.
Yeah, exactly. Resi still has its place, I think, at the beginning of your investment journey, most definitely. For me, I just wanted a bit more aggressive approach, and I think others. I'm probably the minority on wanting that more aggressive approach. I think people are kind of happy on that kind of longer term approach. But for me, I just wanted to bring the time frame in, and then started looking at avenues of how I can do that.
Well, it's so true, because ultimately this is where we are right now, and this is where we want to go. And you've got assets, resources, liabilities, things like you can. Over the next 30 years, most people can build a property portfolio and buy 5 investment properties that will probably give you $100,000, $150,000 of passive net income after 30 years, right? And that's that's working hard. You've got to re-leverage and get the debt and to make it all happen. It's not easy to do that. But then 30 years is a long time. So what are the things that you're going to do to solve other people's problems that's going to give you more value? So those things are like renovations. Then there's things like subdivisions if you own the property. So you can buy properties that have frozen equity built in, where you buy a property, and actually it's exactly like the people. Now we're going to dive into your kind of acquisition portfolio of these deals that you've done, where somebody owns the property and you're creating a development. You can hold those portfolios. But then what are some of the accelerators that we can really speed this up? Because you don't want to do it in 30 years. You don't want to do it in 20 years. You want to kind of squeeze this time frame as much as possible. And the way to do that is increase the income and increase the ROI of the investment. And there's only one way to do that, is with business or with development, like developing, which is a business in itself.
Yeah, I think people like Adrian as well have a really good background. Like his job, pardon me if I'm wrong, being a civil engineer, is literally managing work crews and flows and Gantt charts, and it's pretty much the same job but on a big heavy scale. So he's already got 10 years experience of actually doing that. It's just the transference into a slightly smaller scale industry.
Definitely. Transfer of skills was quite easy based on my history.
Right. Okay. Okay. Well, I want to learn what the everyday Joe, pardon the pun. Can an everyday Joe do this? Like these no money deals? No money deals down. Is this something we can?
That's another pun, Joe. Average Joe, mo money down.
Mo money, no money.
Can the average Joe do this? Yes, 100% they can. It all just comes with, you need the proper learning at the front. You need people to mentor off. You need to read books. You need to do courses. You need to attend live workshops. You need to kind of be in and around the the people that are doing this day in, day out, learn from them, and then get your knowledge base up to a point where you're feeling comfortable, you're looking at deals, you're assessing the bottom line number and thinking, okay, would this work if I was to take this on? And I think once you look at a few of those deals and you know your profit margins are kind of close to where they need to be for the deal to be viable, I think that's when you're kind of ready to take the next step. You know, it's all about problem solving. You know, you're going to have issues, you're going to have problems, you're going to have to talk to consultants. So once you understand how to find the people that have the knowledge, you don't have to have the knowledge, but you just need to know how to find those people. The people that do this every day, the town planners, the architects, the builders, and you can lean on them. So once you get the basic skills under your belt and know who to lean on and create a real good little circle of consultants that you can use, then you're essentially ready to start moving forward and really jumping in.
I think that's the main point, Joe. Like, so Adrian, who already had experience in engineering, is chartered, done it for a long time. He still went and got himself educated. He still did multiple courses and conferences and read all the books and did that. I get sent all the time from like clients and that. They go, oh, they send me the resi side. I'm like, oh, Steve, what do you think of this for development? I'm like, this is the last thing you should be looking at. Yeah, realestate.com is the last thing you should be doing before you're looking at doing a development.
Yeah, without creating that base, you're going to get things wrong. And if you're trying to get people involved and do no money down deals, it's one way to piss people off and lose a lot of money. So that's what you do not want to do, because your development journey will be very short.
Are there any courses or books in particular that you were like, oh my gosh, like this sums it up nicely. This fits. This was it. This kind of helped me. Like, this is the unlock. Maybe not the unlock for everything, but were there any solid, like, foundational things that you read or learned?
Yeah, look, I did. The first course that I did was Bob Anderson's Property Mastermind course. Attended a whole heap of their conferences. Attended a couple of Rob Flux's conferences in Sydney, the Property Development Network, and just talking to like-minded people, doing the courses, talking to people that, you know, live and breathe like you do and love it. It all helps. Get as much of that as you like. Get as much of that under your belt as you can before you start out.
Yeah, I think seeing real life case studies is a big thing as well, because I find most like novice like developers, they go, oh, I can look this margin this site, but they have no idea how to quote all the actual stuff you need for a development. They're just making up numbers. So like you said, you need to know the town planners and the architects and the builders, even to the point like I'm talking to you every day where you're like, oh, I just got off the phone with the builder. Like you've got relationships with the builders, which we're going to go into, but sometimes they get involved in the deals as well.
Yep. Yeah, and that's the case with one of my deals. So we'll go into that and I'll explain how that all came about.
Okay. Well, let's talk to these things. So I guess that's kind of the reason why I wanted to get you on, was that just one more concept. We had Richard Morgan on the show, and we were talking about like cash flowing and stuff like that. And I'm like, so he's heavy into development. And he's like, no. So what I want to do is I want to maximize my return on investment while I'm young and keep building that nest egg and build it and build it and build that nut, essentially, to then when he wants to transition and convert that value, he wants to convert that value into a cash flowing asset. That's when he'll sell everything down and then go into more commercial, which is going to give him whatever, Steve, you said on the outset, was 7% yield net. But he's building and multiplying that ROI at the outset. But it all starts at the beginning of building a solid foundational of resi, and then it's just different phases and stages of a portfolio. And it's just how quick you do it.
You can phase it as well, Joe. Some developers that I know, like obviously, like will do a site and keep one of them. They do a townhouse and they keep one of the 8 or whatever, and you can still build a base portfolio. But again, that's managing your servicing and trying to tie up like what you're actually trying to achieve, what time frame, how much you're earning in income from the development, plus your sources of income, like with Palise property for Adrian and things like that, and managing all those things.
Yeah, 100%. Okay, well, let's chat about the first one. So, give us a bit of a how did you get into this? Like, give us what did it start? What was the start of buying this first no money down deal? because it sounds silly, but it's the truth. So give us the snapshot. What happened? Give us the story.
It was a photo of Adrian in front of a Lamborghini, wasn't it, on social media? And then the leads just flocked in.
Yeah, the Lamborghini was gold too. My gold Lamborghini.
Golden Lamborghini. Yeah.
Definitely not that. No. Yeah, look, the first deal, the stars kind of aligned, Joe. I know it's a bit cliche saying that, but it kind of did. I went through all the, went through the training, did the courses, understood how to do due diligence, who to talk to in my kind of patch, my area that I was going to kind of look at. And then once I got to that point where I was really comfortable, ready to go, had things, had structures and companies set up, everything you need to start out. Just so happened that I kind of had an acquaintance that I knew that sold a business, had a bit of money, bought a commercial property through Steve, and was kind of thinking, well, what am I going to do with my money now? And he kind of just said, look, what do you think? And I was talking to start it out, I was talking another commercial property. And then he kind of said, oh, yeah, I've been thinking about getting into development. And I was like, well, beauty, I've literally just finished, months and months and months of getting to a point where I'm ready, comfortable to start. We had a bit of a chat on how it would look like, what the returns would look like. I ran him through a few scenarios that I had already looked at and kind of said, look, I think these are close. This is why we would go for one. This is why we wouldn't go for one. Kind of pitched my previous life as an engineer, and like you've already kind of touched on, transfer of skills. I was building $50 million bridges. Now I'm building a $1 million house. Same thing, just the scale's different. And we got to the point where he was comfortable, ready to jump in. He'd been thinking about it, and we teamed up and went for it.
Okay, well, you've jumped to the good parts. Like, I'm interested about like the whole searching phase of how did you go about and find like what the actual. So you said, hey, I've got multiple areas here. I've got 6 areas or 5 areas or 10 areas. Like, how did you think about that to then know, holy shit, I've got a deal here?
Yeah. I also want to reiterate that Adrian set up all these structures and finance and companies and all that stuff first as well. That's the first thing you have to do before you even start looking at the deals.
Yeah, look, it's about, I always wanted to do something around, like the first few around where I lived. I don't know, it's kind of like your first investment property. How many people buy in their backyard? It's kind of that type of thing. And the deals I was looking at were close to working. So I was like, well, I think the numbers work in this area. I just need to find the right deal and make sure the numbers work, the site's right, and I'm comfortable with it. So that's just what I did. I just went out once kind of had an agreement in principle with my investor on what the deal would look like. And it was a matter of just finding the deal. That's what I did.
Okay.
I said, I just went to look for it.
You didn't go out there and find a property and secure that under contract. You said, hey, look, I'm educated. I've gone through the process. I've gotten to this point, and then met your investor. Because essentially to run a deal, you need someone to find the deal, and then you need a borrowing ability partner and a cash partner and someone to run the deal. It's essentially those 4 things: someone to find the deal, someone with cash and someone with borrowing, and someone to run the deal. In this instance, you're the beginning. You're the someone to find the deal. This guy is the money partner and the borrowing capacity partner, and then you're the 4th component of actually running the deal. So you've got your kind of quadfecta in 2 people. So someone who you've got a lot of time to find these deals and to run them, and this guy's he's just sold his business. He's flat out trying to look for investments and living his best life. He hasn't got the knowledge, the skills, or the time, and he's got the borrowing ability and the service ability. So it's kind of like a perfect pairing.
Yeah. But as Adrian mentioned, he actually showed him some the deals that he was looking at. And it's not just, he's not sending a realestate.com link to them, Joe, being like, this looks all right. We should be able to make some money. Like I've seen the spreadsheets, like they are like 7 tabs long and like pages and pages of numbers for feasibility analysis. Like it's not a low level thing. He's really dumping numbers.
Yeah. One of the things that, people that start off in development really struggle with is what comes first, the chicken or the egg? Do you find the deal, then find the investor? Do you have the investor find the deal? Both options work. It's just how do you convince the investor without the deal? And then how do you find the investor? How much time do you have to find the investor once you got your foot on the deal? So, in my case, I had created enough confidence in my investor that they were happy to sit there and wait for the deal, and wait for me to bring them a deal.
Yep. Epic. Oh, that's unreal. Okay, so and then you got the relationships. So how should we think about relationships with investors? Let's say we know how to kind of find deals, and we have the time to run the deal. So we're that component, and then the other guy is the borrowing ability and serviceability and cash. How do you set it up with someone like that? Do you get company structures and all that fun stuff?
Yeah, there's a lot of different ways of setting it up. Most structures are kind of a corporate a unit trust with a corporate trustee. Just kind of standard company structure. Nothing too difficult really, but you can get quite complex. At the moment, the deals I'm doing are quite simple. Like the structure is quite simple.
It's still, I think it's worth pointing out on the different deals, you've got different investors sometimes as well. Like sometimes the builder's getting involved in that. So it's not just as simple as here's a rich guy with money being like, yeah, go nuts, Adrian, find me a good deal. Yeah. Sometimes you actually bring through multiple people as well. But again, that's normally a solicitor and accountant's kind of issue. Yeah. I think that the main thing, Joe, and probably the question, Adrian, is like, how do you normally approach how are we doing the split? And I imagine we're going to talk about this on each deal, but like that's what most people care about. How much money are you going to make me, and how much do I have to give you as the basically the development finder?
At the end of the day, everything's a negotiation, Steve.
Yeah.
You can go out there looking for as much profit as you want. The investor might be coming to you thinking, well, I could make X amount of return if I go down this investment route. So what you're presenting to me needs to be better than that option. And then obviously with development, there's a bit of risk involved. Whatever numbers you put in front of them, they're probably going to take a few percentage off that, knowing that things may not go right. Your numbers might not end up exactly what your feasibility says, which they barely ever do. They could be up, they could be down. They never bang on the number. So it's a negotiation. Everything is a negotiation when you've got developers and your investors and you're putting them together in a development.
You said one thing. You said one thing that stuck with me when I was just like, I was sort of amazed when you were doing these deals. I'm like, why are they giving you so much money in percentages of the pie? And you said you're like, without me, they're not making any money. And I went, okay, that's a good point. Like, if you can show that the numbers are there, it's money in the bank for them, and they go so you can theoretically charge what you're worth.
Exactly. If it was that easy, everyone go out and do it themselves. There's a lot involved, and a lot of my investors don't actually understand that until they've teamed up with me and they see what's involved. And I'm starting up and getting to a stage where your design's approved, your builder's locked in, you've got finance. People underestimate how much time is actually involved up front. So a lot of them are happy to just be the armchair investors. Get their return. Sit back, let you do the work. It takes a lot of time, it takes a lot of effort, and people just don't have that. They might have the money, but they don't have the time or the experience, and that's what they leverage off me.
We see the same thing as all three of us that are buyers agents. We get the same thing. They're like, well, why would I pay you to find a property? And you're like, well, why are you talking to me then? You'd be off and doing it right now. We're obviously offering some value, whether it be research, saving you time, below market negotiation, due diligence, like we're offering you something, like take it or leave it kind of thing.
Yep. Providing a service, Steve.
That's how I don't talk about it like that.
Yeah, but I'm confident in my ability, Joe, like you.
Oh, here we go. Speaking of confident in their abilities, let's talk to your deal, because we got a little slideshow presentation thing here, because there's a couple of people in the comments saying, "Oi, tell us about this deal. What the hell is it?" And what I love about this initial picture here is it just doesn't look like anything great. Like it doesn't. I look at this deal and I'm like, high-end duplex? This just looks like a place with a trampoline. Like it doesn't look like anything special. So, and that's exactly it, Joe.
It wasn't anything special. It was a early 1900s shitty house with asbestos eaves, everything that you don't want in a house. But the numbers worked. The risk was low. So we went for it. So yeah, this was when I kind of had the investor on board, we had structures, splits, percentages, everything kind of at a point where everybody was happy, and I started search. This site came up off market, would have been 3 or 4 weeks into the search. And between the start and finding this site, I probably had looked at another 10 sites. And same thing, did the numbers, showed like if we're out by a mile, I didn't bother showing the investors, but if it was close, I kind of said, ran them through the process, run them through the due diligence, the appraisals from the agents, everything to give them confidence that I'm taking the appropriate steps to make sure that the bottom number that I'm putting in front of them is as accurate as I can get it at this point in time. So they had confidence seeing the process a few times and why we weren't going for those properties. So when this one came up and a lot of the boxes were ticked and the numbers worked, for them it was easy, go for it. Let's do it.
For a first-time investor or first-time developer, I should say, do you typically look at the older houses in the suburbs that you're looking, but knowing that, like, especially if it's a knockdown type development, like that's probably where you're going to snag the best bargain till the number's going to make more sense? Like there's no point looking at a brand new house, obviously. So is that kind of part of the search criteria? Is like, cool, let's find the site, square meter site that makes sense, then find the older houses?
Yeah, it kind of is. Kind of like when you're just buying a normal resi investment property, you want majority of the value of that property to be in the land, So, if you're at 70-80% of your purchase price is land value, you're essentially not relying on the building that's sitting on it. So it's kind of the same with development. Not saying that you might find a site that stacks up that's got a beautiful house on it, but a lot of the time what you're finding is old crap that is dilapidated and kind of 50 years old. The majority of the value of the asset is sitting in the land.
Okay.
And are you building relationships with the agents? Like you said, this was off market. So what did that look like? How did you actually get this deal?
Mate, it is the same. It's the same as a buyer's agent. Like a lot of the best deals come off market, and building the relationships is key. Agents are one of the key. You can consider them a consultant of sorts. They're going to find you the deal. You're going to lean on them during the design phase. You're going to make sure that they're involved because you want to put a product to market that they're confident they're going to get the right price for. And there's nobody better to give you that information than agents. So it's just about finding the agents that you're comfortable with, telling them what you're looking for, why you're looking for, or what your budget is, and just waiting for the right one. Like the 10 deals, let's just say, that I looked at beforehand. Not all of them were off market. Some of them were on market. But a deal's a deal. If it works, doesn't matter if it's on market or off market. It works. But yeah.
Interesting. An interesting point that you've made there is that you say to the real estate agent, hey, I need your help throughout this entire process. I am buying a development site and I am selling 2 properties. Are you saying to them, I will get you, if you find me a development site, I would give the listings to you to sell? Is that what you're saying?
No, I don't say that.
Oh, okay.
I don't say that. At the moment, they're representing the seller, right? So from them, if I've got a very strict criteria and they have a site that ticks that criteria, and I can purchase the site for what they've listed it for with the seller, for them it's a quick in and out. They've got a seller, they've got a product, they've got a buyer, easy transaction, let's get it done.
Yeah. It's a rundown house. It doesn't look good. It doesn't look pretty. Doing an open home and running people through it, they're not going to like it because it's a bit ugly and trashed. And you're like, cool, I'll just bulldoze it.
Yeah, it depends on the market too. Like I've talked to a lot of agents in Perth where I do a lot of my work with Steve. Like it's silly for them to do a lot of deals off market when the market's going so crazy. So it just kind of depends on what the market's doing. At the time that we'd secured it, the market was kind of stagnant. It wasn't kind of going up or down. So from the agent's point of view, a transaction is a transaction. He had product that suited my brief.
The agents know as well, Joe, if you do work with them well on that, they're obviously going to get the listing post anyway, so they get to double dip a little bit there as well. Adrian had a funny one a couple of weeks ago. Adrian had 2 off-market deals from 2 different agents that were selling 2 houses side by side that were old and dilapidated. He's like, Steve, I found the golden egg. We've got 2 houses with different agents. He was trying to get me involved in that one.
Yeah. Yeah, it's good. It's good when that happens.
And they both didn't know about it.
No,
I'm sure
no.
The neighbors will chat at one point. But that's actually a really good negotiation tactic. Now, I'm not saying it's ethical on the real estate agent side of things, but if you are a developer and you say, hey, look, I'm going to be developing this site and knocking it down one into two. So if you help me on this one sale, you will have 2 other sales that you can potentially get if we've got a good relationship. Not saying that they should do that. It's up to them. They have the right of the vendors, but incentives are incentives. Not all agents by the law. Okay, cool. So what? I don't know what these slides look like. Oh wow. Okay, you've changed it. You've changed it very well. What's this?
Yeah, much better looking product. Much better looking product. So this is the architect's facade design on the product that's going to essentially replace the old crappy 1950s brick home.
There we go. Beautiful. Okay. Pretty is profit. There we go.
Bit of a weed problem.
Yeah, a lot going on. And I thought you had blue
pretty weeds.
Okay.
Yeah, just a progress shot, from a few. It's probably a month ago now on the site itself, and how it kind of transforms from being a brick home to a nice looking home.
Are you going 2 stories or 1 story?
Yeah, 2 stories.
Okay.
Double story.
Then you're going to
roofs on now.
Incredible views of the ocean.
Very good views. Very good views. Yes.
Yeah. Sorry for this neighbour up here.
One of the things I've noticed Adrian does as well. He actually, you correct me if I'm wrong, Adrian, but you like the lifestyle locations where you can force something like that as well, because it's another layer of like, oh cool, if I build 2 stories, we then get ocean view. So I've noticed a lot of the deals you're looking at are like on hills overlooking like cliff faces and oceans and things like that. Is that so you get like a premium price on the sale? So hopefully like you'll do your numbers, but you might get cream on top from emotional buyers?
It's more so than nowadays. I think definitely what I looked at, the numbers or the profit margins are looking a bit better on sites that have a more premium product. And I think that's just down to how the costs associated with developing nowadays, build costs have gone through the roof. Everybody knows that. The council are dipping their finger in whenever they can. So, if you're kind of putting a pretty low end product, you're not really getting close to get the numbers to work. Where if you're getting people that are at the end product, they're buying with their heart, and you're really pulling at those heartstrings because you have the views, you have the really nice facade, the nice internal, you're giving them everything they want. That's when you're getting the premium product, and your numbers start looking a hell of a lot better. So that's just something I found. Not saying it, it can't happen.
It's also weirdly like a premium affordability where like I'm making up numbers here, like the house next door to you might be like 2 mil, and then this half a duplex is 1.6. So you actually get people that want that area, but can still get in with a premium product that's affordable in quotation marks.
Exactly. Yep.
And it looks unreal, right? It is going to be much cheaper. Well, maybe not much cheaper. It's not going to be too far off different to this one. Okay, cool. So, talk us through this.
Yeah, so just a bit of a breakdown on the structure of the deal, and I'll do that for the few deals that few developments that I've currently got going on. They're all a little bit different to each other, which is good for the audience to see, I guess. So this one deal, single investor. I went through the structure, unit trust with the corporate trustee. Now the thing, I guess, that's different in this one is there was no bank financing involved. The investor wanted to purchase the site in cash and fund the construction in cash, which is music to every developer's ears, really. If you can find that, you're onto a winner.
So can you talk to that a little bit more? What does that actually mean?
It means they've personally funded every aspect of the development, from securing the site to getting the design approvals to paying the builder to construct it and to sell it.
How much? But that's a lot of money.
Well, we're going to go on the numbers. We're going to go into the numbers.
We're getting ahead of ourselves. Okay.
Remember, Joe, everything's a negotiation. Okay, that's key.
What's a management fee?
Management fee. So part of the negotiation, as a developer, there's a lot of avenues in how you can do that. A lot of developers and investors purely go down a profit split at the end. This particular deal, because they funded it cash, they were kind of like, well, if I put this money into a commercial asset, I'm getting 6%, 7%. So why wouldn't I do that? So part of the negotiation was, okay, well, what about if you're financing it fully? I will pay you an interest rate through the process. So the money that you're investing, you're getting an interest rate return to it. So it's like you're investing in a commercial property. You're still getting the same return. But in return, I want a management fee. Okay? Then at the end, the deal was get an interest rate, I get a management fee, we split profit at the end of whatever's left over.
Yeah, but you don't have any money. There's no money down, baby. That's you can't.
No money down.
Rules. How are you paying this guy an interest rate on his money when you don't have any money? There's no money down.
His interest is capitalized and paid out of the profit proceeds. So all paid at the end.
Well, what he's saying, Joe, is normally if he was negotiating, I get 30% of profits. He is then taking that interest that he would have lost if he left the money in the bank off the profit margins and then get whatever X, Y, Z's after.
Yeah.
Fantastic. Okay, so it's just a negotiation on the term. I thought what happened is he paid you the money, and then what you did is you paid him out of his own money to pay for the interest.
Adrian's actually just doing the honest thing and being like, this is your opportunity cost that you've lost. Yeah. So let's take that into account because you funded that. But do we want to maybe give you a quick summary of different types of ways you can do these projects, Adrian, in terms of like, obviously shared profit, get paid a management fee, combination of both, like just a general summary before we go into the other deals and the numbers on this one?
Well, each of the deals kind of cover how it can actually happen. So, yeah, let it play out, Steve, and we'll soon find out.
Right.
Let's play ball. Okay. There's a big spreadsheet here, so I don't want to overwhelm people, but oh, shit. Can't zoom in.
That's it. So that's the one. So, yeah, pretty standard feasibility.
Yeah.
That's there. That goes through, land acquisition costs, construction costs, holding costs, everything associated with doing a development. Regardless of what development you do, you will be having costs come up in these areas. Like I said, you're leaning on consultants in the initial stages to give you estimates put into your feasibility to make sure that when you get your design approved and you're getting your pricing come through, that you're not getting any nasty surprises. And yeah, at the end, the feasibility sheet used at the end puts you at a profit margin, and the profit margin needs to be, well, if you're going down, conventional financing, it needs to be at an adequate level for you to obtain finance.
So do you also just go over? So just say the land price, the construction price, typical other costs generally as a whole, and then like show the number at the end to kind of get the 20% or whatever it was.
Yep. So this deal, all in land cost was roughly $2 million, maybe just a bit tad over. To get all the design approvals was circa 70,000-80,000, which is always, unless you're doing a really big townhouse kind of development or something similar, you'll always be around that kind of ballpark. Construction costs were just shy of 1.7, including contingency for this duplex. Interest costs are interest costs. They're gonna add up and they make a massive amount. As you can see there, the finance costs themselves are zero, and that's because there was no bank fees or application fees. So it's purely just the interest that's payable to my investor.
Oh wow! Oh yeah. Then, so when Steve, you said that's very generous of you to do that, you're not bloody wrong, right? You are paying him an interest rate to hold his money to run a development for him. That is, he's
correct.
getting. I mean, obviously his money, but it's 312. Not a lot of people factor that into the deal.
Yeah. You've the way I thought about it was if he parks his money into a commercial development, he's going to get 6 or 7%. And he buys it in cash. that's the amount of like money he's going to earn over the 18-month program.
So how much cash did he actually end up putting in?
At the moment, it's high 3 millions.
That's incredible that you can get, and that's the interest. Oh, there it is. Total development cost $4,200,000 minus the selling cost.
minus the interest there. So
yeah,
and the selling costs, agent costs, and all that type of stuff.
She had about 3.8 mil.
As this was your first kind of proper development, was there any kind of things that took way longer or harder than you expected? And was there stuff where you're just like, oh, that was way easier than I thought it was going to be?
Yeah, there was things that didn't go to plan, as they always are. A couple of specific items on this one. Getting the gas disconnected. If anyone's had to do with Gemini, they're not fun. Something that's very, very simple. We probably lost 6 to 7 weeks just waiting on Gemini to cut the connection.
Okay.
So things like that weren't accounted for. I didn't expect it was going to take that long just to cut a house feed or cap a house feed. We also had another issue where the cadastral boundary of the site didn't actually align with the boundary that the survey essentially had in their system. And we found out that once kind of the building and the set out didn't align with the walls and the fence that were there, we actually found out that the whole northern side of the street had a survey misalignment on their boundaries by about 400 mil, and that's why we actually couldn't get the boundaries to work, because the duplex we'd minimized the amount of distance from the edge of the building to the fence, where the fence actually was, or where the boundary actually was, encroached in that distance. So it actually would have been a showstopper if we couldn't realign the boundaries. But good surveyor, again, having good team on board. He knew exactly how to tackle this problem, sort the problem out. We left it in his capable hands. 2 to 3 weeks later, it was sorted. So that it was probably closer to 4 weeks, really. Another month lost. So that's the type of thing. Like, how do you pick that up? But these things come up.
But it's worth pointing out, it's a risk. That's the risk with development. Is there are things that are massive showstoppers. We had one recently. One of our clients is trying to do a child care site, and next door caught wind and then did an application as well, and theirs got approved and their one didn't, so they can't build the child care site anymore.
Oh wow!
That
hurts. That's a lot.
Yeah. So
okay.
But, that's good. So some good margin there.
Yeah, this is great. It's funny. Someone jumped in the comments and said, "Well, you still need a lot of cash." So, just to reiterate, what have you put in the deal so far, Adrian?
I have put in half of my cost to create the corporate entity that owns the site, so about $1,500. But how much have I put into this development itself, the actual development?
Yeah,
not a cent.
So you're lying. It's not no money down. It's $1,500 down. It was
$1,500 down.
If you want to look at it like that.
All you should have done is get the investor to add that onto the profit margin and then get it fully taken off at the end.
Could have. Imagine that interest on another $1,500.
So let's just recap. Bought it for $1.93 million. You had to have stamp duties, legals, all of that kind of stuff. You got a development permit. You got a building permit. You then had to build, the beautiful, pretty, this sucker here. You had to make that really pretty. That is going to cost $1.6 million. So it's not bloody cheap. Construction contingency and then titles, $26,000. So construction contingency, that's only like $40,000. What is that as a percentage? Like, is that contingency massive? Like, is that normal?
5%.
5%. Okay.
Yeah, I've mucked around with those numbers because we've had a few of these unexpected costs come up. So I've taken them out of contingency, put them into the construction itself,
where they actually went. Okay, cool. And then
where they've actually landed.
Finance costs. Let's just say you didn't borrow it from a lender, but he was paying the guy. Agent key. So what did you actually sell? Where's our sales? Oh, over here.
Zoom back out.
Oh, zoom back out. Okay. So How much are we selling them for?
So we're selling them for 2.4 and 2.45 million each, which is a 13.8% profit margin and 539,000. So, like I said, at the beginning of this venture, that profit margin was 15%. So, combined with the issues, the time delay, the actual problems, it's cut down a little bit. But that's why, especially if you're going to financiers, you need to have that profit margin because things don't go to plan. So you plan for the 15, and if it ends up at 12, it's still a good margin. But you can't walk into a deal with 5% and then end up in the in the red.
So how much are you selling Unit 1 for?
2.4 and 2.45.
Wow. Oh, I imagine the two only 2.45 for the one that has the water views. Very interesting. 100 grand, but still, like that's
2.4 for 2.45.
Oh god. Oh, 50 grand.
Hey,
thanks. 50
fluff
grand.
it up, Jeff. If we're going 2.6, 2.7, lovely. No problem with me.
Jeff. Jesus, wrong show. Okay, cool. So what's that? 4.95, and that's how it's done. All right, that's incredible, mate.
With profit margins at the moment, I find it funny when you get like people still talking to like, oh yeah, 25%. That I know that doesn't exist anymore. You're generally looking about 15 to 20%. Is that right?
For resi deals, yeah. Look, you can probably get up close to the 20-25 when you're looking at industrial deals. A lot of risk again associated with that avenue, a lot more money required. But yeah, you can still get them. Not really on resi unless you're doing some pretty big resi developments.
All right. Yeah. One question that I have is, I'm not sure if you've answered this, and feel free to not answer it. But 500, so $500,000 in profit. That's for the overall deal. How have you decided to split this deal up? Is it just 50-50 based on the deal?
Yes, 50-50 split on the profit margin.
So your cash on cash return.
Can't calculate it. You cannot calculate it.
You got to carry the one. Carry the one. Carry the one. Joe.
Carry the infinity. Carry the infinity.
Well, you can work it out, Joe, off my $1,500 contribution.
Yes. But that's the thing as well. Like I hear people saying, no, it needs to be 20%. As soon as I hear that, I'm like, oh, okay, you don't necessarily know what you're talking about. Great. Okay, cool. We'll have an education phase. But it's like, cool, I'm going to make $500,000 here. Like 20% doesn't, like 20%, don't get me wrong, would be lovely. It would be great to get 750,000. But I'm still going to be happy with $500,000 on the deal. The other time is time frame. How long is it going to take to kind of run this deal?
It should be about 18 months.
Wow.
I think Joe, a lot of people get caught up with that profit margin. They say the profit margin, but they're not including how they had capital growth over that time. So the market moved, they bought an uplifting market and like actually made 10, 15% in capital growth. And then they're like, oh, great, I made a 25% profit margin. They didn't. They made a 12, 15%. The market did some of the heavy lifting, but Adrian's numbers are just today's numbers. The market keeps moving. Fantastic.
Yeah.
Also,
exactly.
don't sugarcoat. If it happens, the opposite happens and it goes down, then that eats up your profit margin. That's where some developers make zero or a loss sometimes.
Yeah.
Yeah, well, actually, that's a good point because you're going into the high end market, right? Like selling it for 2.4. That's a lot of money. That's like, is the market still there? Is it still, because we haven't? So I guess the point to make is this deal hasn't gone through yet, right? You can see this was taken last month. Oh, I'm not sharing my screen, but this was taken last month. This design, so the roof isn't even on the sucker yet, or is it?
Roof's on now, just.
Oh, good. Good. She's watertight.
Oh yeah, that's the risk that's involved with development. You know, that's why you need the margins there. If the market does take a little bit of a turn, you need to have enough fat in the deal that you're still going to walk away with something.
The good thing is, I'd say with development, as long as you know what you're doing and you do have a margin, say you've got a 15% margin, if you buy that property and the market drops 15%, it's been a very like high intense exercise to do to not make money, but it's the same argument for the person who's buying a residential property as is. If the market drops 15%, they've lost 15%. So it can actually, if you know what you can actually add some protective layers by having that value uplift as well.
Yeah. Someone's jumped in the comments here. Joe, what's the net? How much has Adrian handled the tax component, GST and capital gains tax on that? How do we think about this when you're running these developments?
Yeah, so the GST is included in the feasibility. I actually haven't shown it there, but underneath the total development cost
credit.
Oh, it's got it there.
170,000. Is that it?
GST is included. Yeah. So the calculation of the profit works out the GST. The capital gains tax is all company tax. So that net number, let's just call it an even 500. We still will get company tax taken off that. So at the moment, that number is gross.
But if you have a creative accountant to do some things, you can then mitigate these things on other things and other losses that you may have throughout your company or other structures. But that I
always find it amusing when people focus on the tax that you're paying. You're going to get taxed if you make money. Whether I give Adrian a pay rise or he does a bigger deal, like you're getting taxed at some point. It's still real money. And to be honest, the bigger the tax bill, the more money you made.
Yep, that big tax bill is a good thing.
Yeah. Do you find? Oh, sorry, Joe. Do you find, Adrian, by going in these premium areas, you might actually be less volatile with those fluctuations as well? Because I know you look at stuff like days on market. You know that area inside and out, so you know that stock disappears straight away. Whereas someone maybe trying to do a less premium area, arguably might be more volatile if there's less demand.
Yeah, I think one of the things to look into when you're looking in a higher end market is there is going to be listings that sit on the market a lot longer than others. So what I do is when I see those kind of outliers that don't kind of buck trend with everything else, I call the agents and I kind of get a bit of information. Why did this take so long to sell? What didn't buyers like in this product? Because I want to make sure that I don't make that same mistake.
Yep.
And then likewise, whatever comparables you use, you call those agents that sold that product. What did the buyers love about those products? What do you think they could have done with that didn't have? You want to kind of create a nice little kind of list of things that you need to have in this property.
Yeah, you're doing market research.
Yeah. One of the questions I have now, when I did my first investment property was $280,000. It wasn't like, I think I had like 400 or 350 borrowing capacity. But what I wanted to do was, I just wanted to dip my toe into the property market. I was scared, didn't know what I was doing, and I just want to dip my toe in there. And you haven't done that with your first development. Obviously, you built a portfolio, you've scaled it, you've done really well on that front. So I can't expect a rookie mistake like that from you. But this is a massive development. You've bought a $2 million house. You've spent $1.6 million, $1.65 million to create two massive dwellings that you're then going to sell for $5 million. These are massive numbers. How do you think about that? And what do you think about people that go for like the $300,000 deals and the $200,000, $500,000 deals? Not what do you think about them, but how do you think about it for yourself?
To be honest, it doesn't bother me. Big numbers don't bother me. Whether you're looking at small numbers, you're looking at big numbers, the process to reduce your risk is the same to me. So at the end of the day, the margin on cost just increases. The number increases the higher up you go with a more upmarket product. But the process to me is no different. I'm comfortable at a low level. I'm comfortable at a high level.
Yeah. I think it's worth pointing out, Joe, he's actually done the lowest risk investment he possibly can and not put any money of his own money in the deal. Whereas doing a small one by yourself is actually more high risk. But again, Adrian's not nobody in the property game. Like, he's got hundreds of commercial acquisitions under his belt. Like, he knows, like, we've bought $12.5 million deals. Like, he's not a novice in this space.
No, well, exactly. And I guess that's kind of not the point, but it's you are comfortable. You're doing infrastructure development. You are literally spending billions of dollars. The decision that you make to put X amount of steel in here is going to cost hundreds and hundreds of thousands of dollars. And I guess it's just that the comfort of doing deals, and then at the end of it, looking at a spreadsheet and being like, wait, I just did a $300,000 deal and it took me 2 years, or I've done a $3 million deal and it took me 18 months and I made far more money. Why am I wasting my time doing something like that?
Exactly.
But it's just I feel like it's a bit of a mindset of overcoming. So we're at the hour mark, and we've only looked at one deal. We do have a sponsor that is currently on the show, so I do have to run his ad. So if anyone's got any questions, throw them in the comment box as well about the developments, because there's two more deals that we need to go through, and I want to tear through those. Let's jump into the ad, and then we'll jump into that. What's the code to get free books? Steve, I don't know.
Same one. It's been free for a year for like Aus Prop. So just type in Aus Prop, it's free. Same thing for the course. If you want the commercial course for free, type in Aus Prop, free for everyone. So commercial courses, commercialpropertyinstitute.com.au, and then the other one's just paliseproperty.com.
That's ridiculous.
But
thank you, mate. Good.
The gift just keeps giving.
He is the beard that keeps on bearding.
I find it funny when people are like, oh, you got to pay for postage. I'm like, it's like $8 and it costs me $7.20. Like, relax.
And what? Yeah, because you've got to pay for the book, right? So it's costing you more than it is for them in postage. It's for the book.
I've given away now over 25,000 books at like $10 a pop, because I have to buy the book from the publisher still. Like, I'm not printing it at home in my factory. Like, I have to pay the book, so I'm still losing money. Like, people are funny online.
Okay, well, I want to let's tear through these deals. What do we got? Southern Highlands, New South Wales, dual occupancy. What's the interest? Is there any interesting story behind this one? Like, give us some of the fun stuff of this one.
This one here was an on-market deal. It was one that sat on the market for a while. It was a couple of months. Now, it was one of the scenarios that I kind of knew what I could do with the site. Again, talked to my town planner, talked to my architect, ticked the boxes, and it was a case of, why is nobody else seeing the opportunity that I'm seeing? Look, the house itself, very bland, landscaping very poor. Probably didn't present that well, but I wasn't buying it for how it presented. I was buying it because what the site could provide. So maybe it's just, the treasure being in the eye of the beholder. I kind of saw what other people didn't with this opportunity.
Yeah. And when you see this, because I see properties all the time that have been on the market for ages, and I'm like, oh wow, what an interesting development site. And then I also think, oh, there's other developers out there that's already assessed this and it doesn't stack. Like, how do you think about? Does that cross your mind?
100% it crossed my mind. It crossed my mind for weeks, but this is where I lean on my team. If my town planners look into it, a second town planner I know looked into it, high level, they couldn't see any issues with it. I'm leaning on their experience and their knowledge. I can only look so far. These guys do this for a living. They know the requirements, LEP inside out.
Right.
So yes, I didn't just make the decision with a blindfold on. I made sure I ticked the boxes and did my due diligence like I would any property that I look at.
Yeah. So that's not a big. Like, why I say that is there are people out there doing this, but it's amazing. I mean, this is amazing. I mean, we've got what 60, 70 people like collectively on Facebook and YouTube on this. And how many people are actually going to go out there and find a no money down development? Not straight away. They'll get educated. They'll get to that point. But then also there's thousands of people that look at these deals. You can see it on real estate. 6,000 people have viewed this property. But how many is actually going to action it and do the development, run the feasos and do that kind of stuff? So it's amazing how many people actually don't take action. So if you do see something on the market a long, long time, it's not necessarily the end of the world. It might have just been the developers that are in that area are now not, they've already clogged up with deals. They can't afford to buy anymore, and they're not into it, and you can snag this
Well,
deal.
We're also in a bit of an interesting time as well, obviously post-COVID, and then build costs going up, and then inflation, interest rates being high. Like, it's not a typical kind of development kind of playground like it was 5 years ago.
Yeah. Are you seeing that?
It's hard, and there's not as many developers as active as they once were. It's just, I think especially in my area, the prices have kind of stagnated for the last 18 to 24 months. So something needs to give. Build costs need to come down, or prices need to start moving again for margins to start making sense. I think it's just people are a bit more cautious. There's a lot of negative sentiment in headlines about developers going broke and just taking on way too much work, and there's a lot of negative sentiment out there in the world that you kind of just need to push aside and just look at your numbers, focus on your job, your position.
Yeah. What is within your control? Yeah. Sweet. Okay, cool. So what I like about this site, just looking at it here, good land size. Obviously, how many square meters is it? If you remember off the top of your head,
it's just over 1,300.
1,300 square meters, and then 30, 35, 40 frontage. Massive frontage.
40, 45, 46 meter frontage.
Oh,
jeez.
Okay.
That's rare to find a frontage like that. So awesome. Okay, cool. And sweet. So this deal is completely. Am I sharing my screen? Can you guys see what I see?
Yeah.
Cool.
Yeah.
Yep. So we've got this little. I guess the key point is we've got this little outhouse. What is this? A garage?
Yeah, it was kind of like a garage converted studio type of thing. But yeah, that's going to get knocked down.
And then what are you doing? Tell us.
So we're doing two things. We're renovating the existing house, moving the driveway, which you would have seen that aerials on the right-hand side of the house, moving that to the left-hand side of the existing house. Then we're building a new 4-bedroom, 3-bath, double-car garage, single-story house to the right of the existing dwelling.
Single-story, 3 bathrooms. What do you need 3 bathrooms for in 1 story? What am I doing? Is that necessary?
Market research, Joe. Part of due diligence.
No.
What do the buyers want?
Yeah. Sorry. If that's all I took away from this take, is probably not the right question to be asking.
No, it's
not. But random question. When you're doing the renovation of an existing property, do you wait while you're doing the construction of the new one to try to double up on tradesmen? So when you get the painters or the kitchen guys, hey, do 2?
Yep. Yeah, okay. You get the best efficiency in your pricing to keep them the same, because this particular opportunity, it's a dual occupancy subdivision, not a normal subdivision. So that right-hand side block of land doesn't actually meet the minimum standard to do a clean subdivision. So it depends on the situation. If I had the minimum 700 square meters, okay? So if I had a 700 and a 700, you do the renovation, chop the block off, sell it as quick as possible. Get money back in your pocket, you're minimizing your interest accumulation. But in this case, couldn't do that. So the next best thing is just hold the plan for the renovation and do all the works as the tradesmen come in and do the new build.
Do you think that's maybe why some of the developers just walked away? They went, cool, I know I need 700 meters, I can't do that, and just didn't look into it further? Whereas you've actually done the work and spoke to the town planners, being like, hey, I think we can actually do something here?
Could well be. I don't know why developers didn't see it. I don't have the answer.
Okay,
but I mean,
that works for me.
It's so easy. In South Australia, for instance, I've done developments down there. It's 18 meter frontage. 18 meter frontage, 600 square meter block, and you just overlay that filter all the time. And it's so easy to overlook a property that's opposite a park, and you get 10% dispensation. And that was actually the deal that we bought. We bought a corner block. And we got 10% dispensation that allowed us to split it 1 into 3. So everyone was doing the numbers on a 1 into 2, but we saw the value of it a 1 into 3. But it's so easy when you know that a minimum lot size is 700 square meters. Let's draw the plot. Move on to the next one. So that's probably, I reckon you're spot on there, Steve. I reckon that's exactly what happened there. So you're able, can you just, I mean, this is going a little bit too deep. So 700 meter square to do a stock standard subdivision, but you can now sell this on 2 separate titles. You'll get 2 separate titles out of this to then sell?
Yep. Yeah, so for a dual occupancy, it has to still be above 600. And it just met the 600.
Oh, beautiful.
Perfect. Let's do it.
Yeah.
Okay, cool. Oh, wow. There you go. Normal house.
But every council is different, obviously, but this council, that's what's allowed.
Yeah.
Cool. Okay, oh shit, now we're bringing 5 investment partners into here. How does that work?
Yeah, so this still has myself and 4 investors in it. 2 of the investors are what we call equity partners. So they're putting cash in, they're on the title, and they're getting a split of the profit at the end. One of those partners is my builder from the first project. So one of my reasons for choosing the builder at the time, not only was he the most competitive, but I built a good relationship with him and talked to him about future joint ventures. He had always thought about it, was interested in it. So I thought, well, that's good, because if I go with him and the relationship continues to blossom, we find another site, I can bring him along. And that's exactly what happened. This site popped up. I brought him up. Let's have a look. As soon as we got there, we had a look. He said, yep, I'm in. So now he's financially invested in the project, and he's building the project. So he double dips from the company perspective and from the investment perspective.
And then how does that go? Because that makes it a little awkward in the negotiation of the building costs of him to actually build and develop the actual property. So how does that work?
Yep. So I still get check pricing done by other builders. So I still ask other builders for other quotes, and he still needs to be competitive. Yeah. Which he was.
Yeah. Yeah. Nice. Okay.
And he's probably looking long. He's probably looking long term as well, where he's like, "Cool, this is not going to be a one-off thing. I'm going to guarantee myself business and get a piece of the pie moving forward on every single deal."
100%. As the exact discussion that would be had. The other equity partner, again, somebody that I knew, heard what I was doing, saw the success with the first project. Again, talked about scenarios, talked about returns, how it would work, how the structure set out. Had the risk appetite to it, had the money, and hadn't ever done something, wanted to do something. Same thing, didn't want to buy a resi property or a commercial property and just kind of, set it and forget it. They kind of wanted to be a little bit more active and accumulate equity quicker to then do something with. So they jumped on board. And then the last 2 investment partners, one person I used to work with and another investor that I know, that had money in their super fund. That, again, getting the standard 8% in their super fund, then getting charged the fees on top of it, whatever the number is. I don't know.
Overall.
But overall, not that fantastic,
Not great.
So how can we improve the super fund return? And again, they were comfortable with it, went through the process, went through how it looked like, talked about the first deal that we had going on. Again, these people are investing. They're investing in me, really. Their comfort level is what I can do for them. So yeah, they jumped on board. So four people financially invested, plus myself with the sweat equity and the knowledge.
Yeah, what I find with you, Adrian, one of your benefits is you're able to kind of basically you bring together really complicated deals and make them simple. And you've done it for me like 50 plus times now on commercial deals, ones where there's always an issue, but then you always come with a solution, even if it is complicated. But then that's how we make the clients money. So we save them money or get some equity or do some uplift. So that is right. And the other one for you is probably worth saying is you're good at building relationships, which is important because now you bring
relationships are everything. Yeah.
So actually, a question I have is there's five partners there. How did you? Was it like, okay, cool, this guy can give me 250, this guy can give me I don't know what you need for the deal. We haven't gone through the numbers. Let's say we need $1 million for the deal. This guy gives me 250, this guy gives me 250. I need to go out there and find these other investment partners. Is that kind of how it worked, or how do you think about like structuring the fall of investors?
Yep. So I planted the seed with the investors beforehand. I had the interest, and kind of went through, look, this is what a deal would look like. How much would you have to invest? What kind of return would you be looking for? making sure that if I found something, they were ready, the money was ready, and the return that I could give them was there, was in the margin. So again, it's kind of, finding the deal first or finding the investors first. Again, I've had more success finding the investors first because people are investing in me. They're investing in what I have to offer. So it makes it easier with no money down deals. Obviously, having the people ready.
I imagine you get a better relationship with the agent as well, because you're not just wasting their time being like, oh, I'll get a buyer for this, and then you disappear, and then you come back. No, sorry, I lied to you again, and you actually are a serious buyer then.
Very true.
Definitely.
What are your thoughts on, you might be talking about on the next one, like options? When you're looking at deals, do you go, this is a good site, let's put an option on the contract and then find the investors?
It depends what site you're looking at. A lot of the sites that, developers that are starting out looking at, they're small sites, they're duplexes, they're small subdivisions, maybe 1 into 3, maybe a 3 or 4 townhouse site. They're not big deals. So going to a mum and dad owner and say, you want to put down an option and really complicating the sale, I find a lot of the time it scares them off. They're not what they used to. They're just a mum and dad. They just want to sell their house. So I haven't gone down the avenue of needing to put together an option. I kind of find out what the vendor is looking for. Why are they selling? Do they need a short settlement, long settlement? Trying to do everything I can to make my offer look as appealing as it can be.
Yeah. Okay.
You can do, like I said, options. Developers use them all the time, but they're more so for larger deals, and it involves you putting your foot on the doors, putting money on the floor.
Yeah.
So got to have that money to do it.
Yeah. Good point.
Cool. Let's hit the numbers of this one. And then first question out the gate, how much money have you put into this deal?
Zero. Oh, sorry. $1,500. $1,500.
Okay. Cool. So purchase price $2 million.
Was that equity that you pulled out of a property, Adrian, or you hard cold cash?
No, just cash.
You
You look after me, Steve. You look after me.
Okay, so $2 million purchase price, so very similar to the last two, but the construction cost is a lot less because you're not building two assets, right? You're knocking down. There's probably a bit more in the construction cost because less in the construction cost because you're knocking down that little studio thing. But the construction cost on this one, just for one dwelling, is 1.24. It's probably all those bathrooms. Okay. Holding costs 27, finance costs 33. So these are two new things. What are these? 27 and 33. They're new.
Holding costs, land tax charges, depending on when you buy the site. Your standard holding costs, rates, water rates, power bills, that type of thing. And then your finance cost is your application fees to a financier. So we had to go down a financier with this one.
Oh, cool. Okay. And then construction cost is the renovation of the front house. How much is the renovation that you're doing on the property, like ballpark?
Yep. So the split is roughly it's 920, 930 for the house, and the rest is the renovation and the garage. So you're looking at just shy of 300 for the renovation.
Jesus Christ! This is going to be a very nice house after this then. $300,000.
It's a very boring house right now.
Yeah, he's also building premium products, Joe. Whereas I think me and you are used to working in like the affordable price ranges where you build for purpose, not for luxury. Yeah. So he's also doing. I also want to point out, like, these construction costs. He hasn't just made up that number. They're on this spreadsheet. On other tabs, there are like hundreds of items he's went through to get that number. It's not just a thumb suck figure.
Right. Yep. Okay, cool. We're looking at the summary page rather than the actual details and stuff, which is boring anyway, but it's necessary.
But cool. That's where I find most initial developers fall over, is they just don't know. They'll just go to a builder being like, how much does it cost to build? They're not doing all the other stuff. They're just looking at the build price.
Okay, so how much is...
So this one here was handy with the renovation because I dragged the builder through the house and said, okay, what do we need to do? New kitchen, this amount, new flooring, X amount. He was there going 50 grand, 15 grand, 10 grand, 20 grand, like putting it there. So we've got another step back. He's looking at it. Yeah.
Yeah.
Just give it to me. How much is it going to cost?
Yeah.
No.
So how much is it going to cost? So how much are you going to sell the front house for, and how much are you going to sell the new house for?
2.05 mil for the existing house and 2.4 mil for the new house.
You've really stuffed your commas there, Joe.
Yeah, there's commas. You really, Is that what you said?
Yeah, there you go.
There you go. Okay. So we've got let's just say 4.5 mil almost. I had $625,000 of profit, 17% margin on cost. And what's the time frame to get this done?
13 months.
13 months.
Not a bad little profit margin for 13 months. All right.
13 months. Yep.
Yeah. So how is your involvement in this in regards to how you're getting paid? Is it percentage, project management costs?
Yep. So this one here is straight profit split. No management fees. The guys using the SMSF, they're getting a fixed interest rate return. So they get paid regardless, and we got to put guarantees in for that. And then the remaining 3 equity partners, being the 2 investors and myself, we have a profit percentage split.
With the guarantee, how do the guarantees work for that investor for the self-managed? Is that basically a document of you guys saying, hey, if this falls over, we will still owe you this figure?
Yep. Yeah, there's proper loan agreements put in place with them, saying that they're essentially, dumbing it down, they're loaning to this corporate entity that is going to pay them a return per annum.
Yep.
And then they've got second mortgage security as well over the site.
Yep. Okay.
As a backup.
Yeah. And is that like requirement for the SMSF? Or it's just that is the requirement? Yeah. Okay. Cool.
Yeah.
Was that a hard or complicated or long process? I know like setting them up takes ages, but was getting that, or is that kind of like a 2-week, month kind of thing?
No, look, the investors just talked to their accountants, and their accountants gave them information of what needed to be in the loan agreement that would tick off the criteria for the super fund. They just provided that. We blended it into our loan agreement, and everybody was happy.
Awesome.
But yeah, it is. You definitely need advice for the super funds. There's quite stringent criteria that needs to be in there.
Yeah, this one. I mean, it sounds so difficult to try and balance all of these emotions and these people and this money. But I guess you're solving a problem for people, and you get paid for that. They're also not doing it. That's the whole benefit of why they're using Adrian, is they actually don't have to worry about it. He presents the numbers and says, "Cool, I've got it from here, I imagine." Yeah.
Yep.
Yeah. There's a question that's popped up in the comments that says, let me just bring it up. And I'm also cautious. How can an SMSF invest in a development? We kind of just touched on it then, but high level, how do you think about this?
My understanding is that an SMSF cannot directly invest in a development. So if you go and purchase a site in your development, purchase a site in your super fund, you can't then develop it in your super fund. This is all not, advice. You need to go to the accountants and get that advice. Yeah. But you can loan to a development with the proper agreement set in place.
Yeah,
so you can't have ownership of a development site in your super fund.
Someone wrote in here,
which I don't.
Sounds like a self-managed super fund gives a loan to Adrian's company with the reassurance that the return is, and no matter what, sounds like someone knows what they're talking about in the comments. But obviously, speak to your accountant, financial planner, and all of that kind of stuff. Incredible. So you've just crushed it. We've done $250,000 on that first one. And then I'm going to say about $150,000 to $200,000 on this second one. So far, we're in $3,000. This is a pretty good ROI. This is not a bad little thing. The funny thing is, that actually, you have a full-time job, and to be honest, a buyer's agent's job is not a 9 to 5. Like anyone that says I do buyer's agency part-time, there's no way. It's impossible. It is a full-time job, but you are still managing not just one $250,000 development, not just two $250,000 developments. You're running 3 developments while also working full-time in a incredible hard paced environment. So it kind of tells me like there's a lot of work, but there's also not a lot of work. Like, how do you balance these things? How do you keep it all on track?
I like to think I'm quite good at arranging my day appropriately. So the work involved in development is more so upfront. So every deal, a lot of the time that you're like, a project may be 18 months long. The amount of time you'll spend in that 18 months probably won't be as much time as you spend in the first month or two. Finding the deals, getting the structures, getting the financing, getting the investors, that is what takes a lot of the time. Once you get past that point, you know, during the design phase, you're waiting on consultants to come back to you. You're project managing. Once the builder starts on site, again, you're project managing. You're not there to sit in your builder's pocket every second day. You got to kind of let your builder do its thing and trust that this builder knows what he's doing. You know, you look into the builder, see the products that they producing, see what they give you. You know, get them to give you weekly updates. Right. Get them to let you know when there's problems. Talk through problems. If you need to go to site, you need to go to site, and you need to have a look at something. But you're leveraging consultants to do a lot of this work for you. I'm not a town planner. I'm not an architect. I'm not a builder. That's why I use these people. So a lot of the time is spent upfront finding the deal, finding the investors, getting the finance. That's where most of the time's spent.
Incredible. Okay, we're getting close to the end, so I just wanted to run through this one. Illawarra, high-end duplex, landowner joint venture. So what is a landowner joint venture? Can you talk to us on what that is?
Yep. So this was a deal brought to me by, again, an agent off-market in the area that I built a good relationship with. He had a guy come in to just sell his property, but said, "Hey, do you know any developers? I think my site's got some value." Adrian, yep, introduced us. We had a chat, and it looks like the numbers stack up. So this one here, it's a dual frontage site, so it's quite, you know, good. Provides a lot of benefits in that point of view. The guy was in it. Yeah, front and back. Yeah, he comes from a bit of a construction background, so he kind of understands how these things happen. He's got very low debt on the site, so it's more of a case of, can I team up with a developer, and can I get more for this land by giving him, you know, 18 months rain at it and producing a different product than I would just selling it on the market today. And the answer to his question was, yes, I can. I can give him another $300,000-$400,000, if not more, by letting me have that land for 18 months. But the key to this one is the landowners need to have little to no debt on their land to make it work. So and the reason behind that is, if they do that, there's enough equity in the land that you don't need to contribute any cash. You don't need any more investors. You don't need to put your own money in. You just essentially are leaning on the value of their asset to finance development.
A good time.
Which is what's happening in this case.
They have $100,000 mortgage on $1 million property, and then they're like, "Oh, well, I've been paying this mortgage for the last 50 years, 30 years, 20 years. I'm still happy to continue paying this mortgage, and, you know, don't worry about that. That's fine." And then as you're running the development over the 18 months, most people would say, no, I need to be making my money because I've got a massive debt on it. Whereas these guys have a small debt. They're fine with it. It's not a problem. It's just everyday life for them. Okay.
I think one of the points that I think the viewers have got to take away from that is, if you are an investor and you own a potential development site, a lot of people think, I'll just sell it to a developer. There are other options of get a developer involved and share the margin. Why sell it and get it? And I didn't even think about this until basically meeting Adrian. Like, if I had a big site, why would you sell it to a developer? Go halves with them and get an extra 400, 500 grand and do it that way. Or if you're an owner occupier, I suppose, as well.
Yeah, a lot of people just don't know. They just don't understand that that's a possibility.
It's also trust as well, I think. Like, going to you turning up to someone's house being like, "Oh, trust me, I'll get you an extra $500,000. There's got to be some form of trust. Whereas the agent, I imagine, said, worked with him before, he knows what he's doing, he's a good fit.
Definitely.
Incredible.
That's exactly what happened. So again, it's just leveraging those relationships, building those relationships so that, you know, you're front of mind when something pops up and someone mentions developer or site, or, you know, they think of me.
Yeah, incredible. Sweet. Let's jump into the. I'm just going to pull up the numbers because it's a little bit easier on this side of things. And that's the old deal. Cool. Okay, this deal. So, okay, is this? Am I looking at the right numbers here? $2.8 million. So you agreed. So what does the deal look like? What did you actually? On the contract, it was a $2.8 million property. You said, hey, I'm going to buy your house for $2.8 million.
Yeah, essentially, I said, I think your property is worth 2.8 mil. We had an agent come in, essentially provide an appraisal. Yep, agree. That's roughly the value as is. The house is in poor condition, right? So it's just another case of a lot of the value of the properties in the land.
Yep.
And I kind of said, well, look, if we can come up with some type of deal, I think that your 2.8 could be 3.2, 3.3, 3.4, you know, a lot better. And the time frame to do that's 18 months. So what's the reason for selling? Can you hold off selling? This is how the structure would look like. This is how we would do it. This is the product that we provide. Again, talk to town planners, talk to architects, talk to agents, put together a little due diligence package for them saying, hey, architects tick their boxes. Agent thinks if I put this product on this land, this is what it can sell for. And then correlate that to the numbers in the feasibility. And then put that in front of the joint venture or the landowner in this instance. And say, look, I think the numbers stack up well to put a deal together.
It's ridiculous. Yeah. Okay. That makes perfect sense. The beauty of this as well is you're not purchasing this property. So that, I mean, a $2.8 million sale would be $150,000, $140,000 in upfront stamp duties, legals, and purchasing costs. Is that right?
That's correct. Yep.
So you just dramatically save.
Yes.
3.5%.
Well, when you say it like that, it sounds less impressive, Steve.
No, but but you're talking 15% profit margins. 3.5% is a big part.
Not nothing. 3.5% of $1 billion is a lot of money. Okay, so development, buildings, construction costs. Okay, so what are you doing on it? What are you actually building? 1 into 2. So you're putting you've got the beauty of a dual street frontage. So you're putting 2 houses, one here and one there. Is that the plan?
So I actually ran 3 or 4 different options with this. One being dual street frontage, dual occupancy subdivision, a house facing each street. Ran the option of him possibly keeping a smaller unit on the back and a bigger unit at the front. We ran a renovation of his existing dwelling, and we ran a duplex. Each one had its own risks associated. Like we found the best product and the biggest margin would be the 2 separate houses, each with its own street frontage. However, there was a lot of risk associated with that option. So we peeled it back, looked at the other options, and at the front of the site, there's 3 or 4 very large palms, and it's very steep coming off the road for your driveway crossover.
Right.
And there's services in that verge. So it was more of a case of, I can solve these problems. However, it's going to take time and money, and it probably needed to involve council a hell of a lot more than what I would have liked, where the duplex auction was less money, but a hell of a lot less risk. A lot cleaner deal, a lot cleaner construction. Yes, the margin was not as much, but the profit compared to what we've had as the agreed site value is still quite good.
I think that's the engineering you, because you rarely hear developers taking the lower margin option because it's lower risk. It's normally best use and most margin, whereas you've been like, no, let's not take on unknown risk. Let's just make some money and get on with it.
Exactly. So going down that safe route still provides a good result for the landowner.
Incredible. Okay, you purchased 2.8 mil. You didn't actually transact on any of that money. You've just held it into the site. Again, how much money did you put into this deal?
0.
Why break a trend? Why bother?
$1,500.
Construction 1.9 million. So let's just say $2 million around about construction, finance costs, marketing. So total development costs 5 million. And then what are we selling the front house for, and then the back house?
So this is the duplex option.
Okay.
We're selling roughly 3.25 mil each. 3.2, 3.25.
Yeah. Okay. So that's 6.5 mil. 16. Let's just round it up. 17% profit margins. $802,000 of profit. And then how are you splitting this? What, 50-50?
Definitely not.
I
wish.
Yeah, because he's putting this guy's put the money, the house, you're doing the admin. You're just the admin monkey on this one.
Yeah, exactly. No, this is this deal. Sorry, you guys leave.
I was going to say, he's got a little bit of leverage in this deal, because now that he knows you've kind of done this work for him up front, he knows what he's sitting on. So I imagine that's a leverage point. Whereas the other way around, when you find the site and you've got like the leverage over the investors, you get to charge more.
Yeah.
Is that the case? Yeah.
Sorry, you cut out there for a bit for me. Sorry.
Yeah.
Oh, sorry. I was just saying he's got the leverage basically, because you've sort of done the upfront work. He now knows what he can do with it. So you don't have the same leverage as when you're taking a deal to an investor's being like, hey, look at all this margin here I can make you.
Yeah, exactly. And you've got to be cautious not to take the piss. Like, you might come up with these kind of opportunities with landowners, but there's no need for me to sit there and say, I want 50% of that. If it was a massive deal that's going to take years, okay, maybe. If I had money invested in it, maybe. But the amount of work required, like, I'd rather build that relationship. Landowner, he might have friends, he might take his profit, he might invest in me in developments after this. So I'm thinking about all those things. I don't look to be kind of take the knife to the jugular and take it for everything he's got. I'm kind of looking at the same numbers as the other two projects. He can take the rest.
Okay. So all I'm seeing right here is 1,500, 250, 200, 200. You have, and this doesn't even make sense. The numbers, the spreadsheet, like, you put this into a calculator, so that's impossible. But you're still working full time. So there's not that many hours. There is a lot of hours and a lot of work and a lot of energy. It sounds like it's like a lot of upfront work. And then the rest, you've just kind of, okay, cool, I understand and I know this now. So you're going to be coming into what's the end game for you? Like, what is it? You're going to crush it. You're going to be sitting on this nest egg. What happens next?
I think, Joe, just keep doing what I'm doing. Like, I enjoy what I do with Steve. I enjoy the commercial buyers agency space. I want to continue doing that. This, for me, and you still need that job for serviceability. If I want to continue to buy commercial properties, I need that serviceability. So my idea is I want to start pulling the profits out of development, and I either want to do one or two things depending on the scenario, put them into more developments and taking larger profit cuts, or putting them into commercial assets and trying to build the passive income a lot quicker that way. It's kind of more for me a see what happens kind of scenario, and at the time, which opportunity looks to be a better. Like, to me, if investors come to me and I'm doing right by them and we're getting some good returns, they're getting good return on their investment, I don't feel like I should just cut them off there. I feel like there's a good thing going. If they make money, they want to keep making money. So why not just continue that trend, keep building on those relationships? that for me is more important. That helping the people that I've invested in me grow their wealth as well. I think that's quite important to me.
Yeah, I think it's cool because this guy here, you've just made him an extra $300, $400, $500, $600,000 on top of what, and then he's going to go ahead and buy a property that's worth $1 million, $2 million, $3 million, and he's going to be like, now what do I do with it? Same with all of the investors that have put money in. I actually did a development where I was just talking about it previously, the 1-3 site, and I sold off the land because I was like, cool, yeah, let's make this money. We'll do the deal and everything. So we bought it, subdivided it, split it off. We sold the land instead of building out the houses. And then we did the development, it was all done. And then I'm like, hey, why didn't we build out? He's like, yeah, well, because you wanted to sell. I'm like, yeah, I wanted to sell because I wanted to get money faster. And he's like, what were you going to do with that money? And I was like, I guess I was going to invest it in something else. And he's like, well, you should have built the properties because you would have tripled your investment. I'm like, yeah, that's true. You should have actually done that. So just keep continuing. So that's the plan. Just keep continually snowballing this into bigger and bigger deals and taking larger and larger chunks of the pie.
In short, yes.
Have you thought about, because I know we've spoken about the transition into maybe commercial and passive. We've even looked at commercial development deals, and yeah, we probably can't talk about on this one, but there's one in the background, Joe, that was like 8 mil in Perth, where it's the owner potentially working with Adrian. So there's scaling with that. Are you potentially, if you do the resi route, maybe going to do what we mentioned at the start of the show, where maybe keep one of them, for instance, like if you do look at townhouse development next, maybe keep one at the end and start building a nest egg if you've got serviceability for it? Or are you just going gangbusters for the next 5 years and make as much as you can?
I think it's more a case of I just want to let the next 18 months, 24 months play out and see what opportunities present themselves. I think it's going to be very dependent on what the market does, what interest rates do. I think that will play a large part on whether we go through the development again, whether I put my money into development again, because I think the quicker we can make that margin on what it costs to provide the product versus what you're selling it for, it's going to make it more appealing to put the money back into the developments. So it's hard to say. It's hard to say, Steve. Yeah. It's definitely going to just be a play out and see what the market does. If the market doesn't do anything, I think the answer's pretty clear. But yeah, I think it's just play and see what happens.
I find it funny because people's strategy changes over time. Like I remember when we bought you the residential, like, how good is this? I've made a couple $100,000 without doing anything. Then when you started working with me, oh, how good is commercial? The cash flow is just ridiculous. Then you started doing developments and you're like, it's even better here. Why don't I do this full time? And you've been on that full cycle of property, which is nice.
Yeah, it just comes with the experience and really understanding each avenue. You know, once you understand that fully, you can kind of put together a picture on what the future looks like and what avenue you feel like you need to take.
Yeah, it's incredible. It's just crazy. Also, at this point in time right now, we're in a very limited supply shortage of property, right? And it feels like, so one of the there was one of the comments was like, oh, if a builder's been building for 30 years, they're probably no good. But they've had a really good run of 20% profit, and then now they're not necessarily building them as much. But that's why there's such a limited amount of supply. So you're taking full advantage of this. But when there's an oversupply of properties, like maybe that's the time to kind of jump out. Like one of the questions that kind of talks to what Steve was kind of talking to is Adrian taking some money off the table as a part of everyday deals as a buffer for if and when something goes to shit. Do you think about it in that way, or like how do you kind of frame it?
I have a buffer.
Yeah,
I have a cash buffer in place. Yeah. I think you need to have something there.
Yeah.
Not leave yourself fully exposed. So I wouldn't recommend digging straight into a development and putting every cent that you have into the first deal and leaving yourself with nothing as backup. I think it's very important that you have something there.
You've done it quite cleverly as well, because there's no money or risk most of the time for your part in it. You're just sort of like the puppet master of putting it all together, whereas you're not putting like your own properties as liability and things like that. So It's not the same as a normal developer chucking in a few $100,000 of equity of another property where they need the same buffers.
Correct.
Good. Yeah. Unreal. I think that there's so much value in this session that you've put forward. Thank you so very much for kind of sharing it. How can people? You've got a little slide here. How can people learn more about these developments? What are you interested in? Who are you interested in talking to? Are you interested in talking to investors? Are you interested in talking to landowners? Like how can people find you and serve you?
I love talking, if you haven't gathered that. So I love to talk to when people get me on the phone, they can't get me off. So I'm happy to talk to anybody, whether it's people that want to learn more about how I started, how I've tackled, certain aspects of these developments, people that want to get involved. I've always always thought a good way to learn is to jump on board with someone that's doing it. You might want to do this too, and there might be the avenue to do that might be, if you've got some money, educate yourself. But while you're educating yourself, invest in another developer. Learn the process and learn what happens out of that, because there's probably a good chance you're going to learn more out of actually having some financial interest in that development than you will in what you're actually reading and learning and talking to people about. And the two of them will combine to probably provide a good base for you then to start looking at these opportunities by yourself.
Yeah. Yeah. So cashed up investors with money that want to learn is what you want. Yes. Okay.
Largely, yes.
Tell them what you tell them. This is unreal, man. The thing is, when you start talking about these massive numbers, like 750, 600, like whatever we just covered off there, with only putting down $3-4 grand is absolutely incredible. You've put down $4 grand, and with your brains, you've been able to create over the last 2 years more money than most people make in their lifetime, and you've been able to create it in 2 years because you spent the time up front getting educated, learning, getting comfortable. Like it's not a 1 year road, path. But you're creating a substantial future for yourself and creating, products for people that need it. So thank you very much for that. Steve, thank you very much for coming on as co-host as well. Palise Property. If anyone wants to talk commercial property, reach out to Steve.
To Adrian. Reach out to Adrian.
Yep. Do commercial property too.
Do commercial property. Well,
in all seriousness, Adrian is one of the most knowledgeable acquisition guys for commercial in Australia. Like he's done more deals, probably more deals almost than me now. Like he's pumping most of our deals for our clients. So he knows the market better than anyone. So you can talk development, you can talk commercial, which has happened as well. Clients have reached out about commercial and they've been like, I actually want to do development, and he's offered that service as well.
Love it, mate. Anything else you want to leave the people with, leave the investors with, Adrian?
I think education's key. I think you really need to invest in yourself first, because this is a high risk environment. Like, just put it very plain, it is. I may make it sound easy. But I invested in myself, and I've come from, my past career where I was building structures that had a lot more zeros on the end of them than this. So you've got to really be confident in yourself before you start taking on other people's money, because that, you want to be providing a result for them. So you need to really spend money on yourself, educate yourself first.
Yeah, you need to respect the money that people are putting up. It is their, like this person that's done the JV with you. This is this guy's life savings. So if you mess it up, this is this guy's superannuation. This is all he's got. So you need to make sure that you are at a level of point to be able to actually find a product for them to be able to do that. Unreal session. Check out Adrian at Palise Property and assureddevelopments.com. Thank you very much, gentlemen. We will catch you on the next one. Let's go buy a property. See you later.
Awesome. Thanks, guys.
See you guys.